Stop what you are doing. I need 60 seconds of your attention right now. Serious. Because if you own physical silver, bars, coins, rounds, anything sitting in your safe or your closet, what I am about to tell you affects you directly. Not next month, not next year. In 72 hours, March 15th, 2026. While every financial channel on YouTube is obsessing over silver dropping from $96 to the 80s, nobody is talking about what is actually happening behind the scenes at the IRS on that exact date. There is a new enforcement phase hitting the precious metals market in 3 days, and most silver stackers have absolutely no idea it exists. Concerned, I spent the last 48 hours going through the actual IRS documentation, the revised 2026 instructions for Form 1099-B, the brand new 1099-DA, the dealer compliance deadlines. What I found is going to change how you think about every silver transaction you make from this point forward. Some of it is going to scare you. Some of it is going to actually relieve you, but all of it is something you need to know before March 15th hits. This is RateScope, logic, not hype. Before I get into the mechanics of what changes on March 15th, I need to give you the context that makes this moment so significant. Cast your mind back to how silver reporting used to work. It was simple, almost too simple. Dealers only had to file a Form 1099-B if you sold 1,000 troy ounces of silver bars or $1,000 face value of junk silver coins in a single transaction. That was it. Anything below those thresholds? Effectively invisible to the IRS. Private transactions between individuals, almost entirely off the radar. For years, silver stackers operated in what the IRS internally calls the precious metals reporting gap. A gap so large you could drive a truck through it. And here is the question that should be sitting in the back of your mind right now. Do you think the IRS is comfortable leaving that gap open forever? Because March 15th is their answer. And the answer is no. Here is exactly what changes on March 15th, 2026. And I want you to pay very close attention to this section because the details matter enormously. The first change is aggregated reporting. Under the old rules, a dealer looked at each individual transaction in isolation. Under the new 2026 instructions for Form 1099-B, dealers must now aggregate every sale you make with them within any 24-hour period. Let me show you why that matters with a specific example. Let us say you sell 500 ounces of silver in the morning, then another 500 ounces in the afternoon. Under the old rules, 2 separate transactions. Neither one hits the 1,000-ounce reporting threshold. You are invisible. Under the new rules, those 2 transactions get combined. 1,000 ounces total in a single 24-hour window. The form gets filed. You are now visible. That is not a small change. That is the entire ballgame for a lot of stackers who have been managing their sales carefully around the old thresholds. But here is where it gets even more interesting, and this is the part that almost nobody is covering. The second change is something called Form 1099-DA. DA stands for digital assets. Now I know what you are thinking. You are thinking this has nothing to do with your physical silver bars sitting in a safe. And you would be right, mostly. Here is the part where you need to lean in. The IRS definition of a digital asset middleman is broader than most people realize. If you buy or sell silver through any platform that processes digital payments, and that includes a growing number of online precious metals dealers, your transaction may now be captured under the 1099-DA framework in a way that physical over-the-counter transactions never were. The IRS is building a digital fence around every exit ramp from silver back into fiat currency. And March 15th is the date dealers are required to have their compliance software updated to log transactions under these new frameworks. Which brings me to the question I know you are sitting with right now. What does this actually mean for you personally? Because here is where I am going to separate the panic from the reality. And the reality is more nuanced than the fear channels want you to believe. Let me tell you clearly what this is not. This is not a new tax. I want to say that again because it is the most important sentence in this entire video. This is not a new tax. New. You have always owed capital gains tax on your silver profits. That has not changed. What changed is the reporting mechanism that ensures you actually pay what you already legally owe. This is not confiscation. There is no law in 2026 that gives any government agency the right to enter your home and remove your physical silver. Anyone telling you otherwise is selling fear, not facts. This is not making silver illegal. Silver remains completely legal to own, buy, sell, and store in any quantity you choose. So what is it? Think of it as a digital fence being built around the exits. You can hold your silver indefinitely with 0 reporting requirements. The moment you sell, the moment you convert that silver back into dollars, that transaction is now far more likely to be visible to the IRS than it was 12 months ago. And if you buy at $28 and sell at $90, the IRS wants their 28% collectibles tax on that $62 gain. The new rules just make it significantly harder to forget to pay it. Now here is what I find genuinely fascinating about this moment, because buried inside all of this is actually some incredibly good news for long-term silver holders, and nobody is talking about it. Here are the exemptions that the hype channels are not telling you about. These are real, these are documented, and at least one of them is going to change how you think about which silver you buy going forward. Exemption number 1, American Silver Eagles. Even under the new 2026 reporting framework, American Silver Eagles remain exempt from 1099-B dealer reporting regardless of quantity sold. Let me say that again because it is extraordinary. Regardless of quantity, you could sell 10,000 ounces of American Silver Eagles to a dealer, and no Form 1099-B gets filed. They are specifically carved out of the CFTC deliverable standards that trigger the reporting requirement. Generic silver bars, reportable above the threshold. Silver rounds from private mints, reportable above the threshold. American Silver Eagles, still exempt. If you have been stacking generic bars and rounds for privacy reasons, this exemption should be making you rethink your strategy right now. Exemption number 2, physical cash transactions under $10,000. The federal reporting threshold for cash transactions remains at $10,000. If you buy or sell silver in person using physical bills and the total stays below $10,000, no Form 8300 gets triggered. Now I want to be absolutely clear about something here because this is where people get into serious trouble. Deliberately breaking up transactions specifically to stay under that $10,000 threshold is called structuring, and structuring is a federal crime regardless of whether the underlying transaction is legal. I am not telling you to structure transactions. I am telling you that legitimate cash transactions under $10,000 remain outside the new reporting framework. Know the difference. It could keep you out of a federal courtroom. Exemption number 3, self-directed Roth IRAs. Silver held in a qualified self-directed Roth IRA grows completely tax-free. The reporting is handled by your custodian, and because the gains on qualified Roth distributions are not taxable, the new 2026 reporting thresholds become essentially irrelevant to your personal tax return. If you are holding significant silver outside of any tax-advantaged account, this exemption represents one of the most powerful legal strategies available to you right now. Now I want to talk about the single most important thing you can do today. Not tomorrow. Today. Document your cost basis, every receipt, every confirmation email, every bank statement showing a silver purchase. Start a spreadsheet if you have not already. Date of purchase, amount paid, number of ounces, price per ounce. Here is why this is so urgent. Without documentation of what you originally paid for your silver, the IRS assumes a zero cost basis. Think about what that means. If you sell silver for $100 per ounce and you cannot prove what you paid for it, the IRS treats the entire $100 as taxable profit, not your gain, your entire proceeds. If you bought that same ounce at $30 and have the receipt, you only owe tax on $70 of gain. That receipt is worth real money, potentially thousands of dollars per transaction. And here's the thing that keeps me up at night thinking about the average silver stacker. Most people who have been buying silver for 5, 8, 10 years have receipts scattered across old emails, physical papers in drawers, and half-remembered transactions from coin shows. March 15th is your wake-up call to get that documentation organized before you ever need it. So why March 15th specifically? Why is this particular date the line in the sand? Because it is the transition point for dealer-compliant software. Precious metals dealers across the country are right now, literally this week, updating their point-of-sale and reporting systems to match the 2026 IRS instructions. After March 15th, those systems are live. Every transaction gets logged in the new framework automatically. And here is the tension that I want to leave you sitting with, because this is where I think the most interesting debate in the silver market right now is actually happening. The bearish argument goes like this: more oversight creates friction, more paperwork, more complexity. Some investors, particularly those who valued the privacy of physical metals, will decide the hassle is not worth it and exit the market. Physical demand cools, price suffers. But here is the bullish argument, and I find this one genuinely compelling. Regulation brings legitimacy. When silver becomes a fully reported, fully regulated asset class, the same way stocks and bonds are, it opens the door to institutional capital that currently will not touch an unregulated market. Pension funds, family offices, insurance companies, these institutions manage trillions of dollars. They are legally prohibited from holding assets in unregulated markets in many cases. A fully regulated silver market is a silver market that institutional money can enter. And institutional money entering silver would dwarf everything retail stackers have done to this price over the last 5 years. The same regulation that feels like a burden to the individual stacker might be the thing that sends silver to prices none of us have modeled yet. Let me be absolutely clear about one more thing before I give you the final summary. Silver is not crashing right now because of March 15th. Silver is not dumping because of reporting rules. Silver dropped because of a 36% margin hike by CME Group combined with a stronger US dollar, creating forced liquidations across the futures market. Those are mechanical, short-term forces. The IRS reporting changes are structural, long-term developments. Do not confuse the two. Do not let the price action on your screen cause you to make panicked decisions about a regulatory framework that is actually more nuanced than the fear channels want you to believe. Here is your clean 3-point action plan before March 15th hits. Number 1. Respect the $10,000 cash rule. Legitimate cash transactions below $10,000 remain outside the new reporting framework. Structuring transactions to stay below that threshold is a federal crime. Know the difference and stay on the right side of it. Number 2. Consider Silver Eagles for future purchases. If dealer sale privacy matters to you, American Silver Eagles remain the only silver product with an explicit exemption from 1099-B reporting regardless of quantity. That exemption has real strategic value in the new reporting environment. Number 3. Get your receipts organized today, not next week. Today. Your cost basis documentation is your single most powerful shield against an IRS audit. Without it, your entire proceeds become taxable profit. With it, only your actual gains are taxable. That difference can be worth thousands of dollars per transaction. The worst thing you can do right now is make emotional decisions based on fear. The second worst thing is ignoring the rules entirely and hoping nobody notices. The IRS is building the fence. Your job is to understand exactly where the gates are. Stay informed, stay compliant, stay stacking. If this gave you clarity that you could not find anywhere else today, hit subscribe. RateScope covers silver laws, tax rules, and market reality every week with no hype and no agenda. Drop your questions in the comments. I read every single one. Logic, not hype. See you in the next one.